Problem 16-33, we're going to do the whole statement of cash flows. So accountants for Morganson Incorporated have assembled the following data for the year ending December 31st, 2024. So we've got some current accounts. Here's a prior year. Here's a current year. We got current assets and current liabilities. And then we've got a data table. And a quick review. We're always going to be starting off with the operating activities section. Here's a larger version of it. So we're going to start off with net income. We're going to back out or subtract depreciation. We're going to back out gains, which means we will subtract those. We will back out losses, which means we will add those. We're going to analyze changes in current assets and then changes in current liabilities. So we need first net income and then add in depreciation. So our net income is over here. So we got 68,500. I'm going to copy and paste that. Depreciation expense is right here. We've got 24,000. We're going to add that back in since that is lowering net income, but it does not affect cash. Next we have gains and losses. So you will back them out, meaning if it's a gain, we will subtract it. If it's a loss, we're going to add it. So I believe we have a gain. So I'm going to copy and paste the 4,500, but we have to back it out, which means I have to put a negative in there. Gain on sale of building. Then we're going to analyze our current assets. Why? Because as a reminder, that's what's next. We're going to analyze the changes in current assets. Cash is a current asset, but that goes at the very bottom of the statement of cash flows, which we can't get to yet. So we'll skip that and go to AR. So it looks like AR went from 69 something to 64 something. So AR went down. So if AR went down, which way is cash going? Well, if AR went down, that means we must have collected the AR. So cash is going up. So the difference is $5,600, 5,600, and because cash went up, we'll leave it positive. Decrease in AR. Next, we've got inventory. It went up. So if inventory went up, what happened to cash? Well, we must have bought it, so cash went down. So we need to subtract the difference. Increase is 8,000. So we will subtract that because we had to pay for that with cash. So cash goes down. Increase in inventory. Next, we've got AP going up, and we've got income tax payable going down. Let's start with income tax payable. That's easier to understand. Decrease in income tax payable. So if income tax payable went down, what happened to cash? Cash must have gone down. We must have paid it off. So let's see, the difference is income tax payable, $2,000. So because cash went down, $2,000. So the next one, we've got AP going up, and our rule says if there's an increase in current liabilities, you're going to add that. So we're going to add that difference. And that difference for increase in AP is 2,400. Increase in AP. Now that one's harder to explain off the top of my head. So just if you have trouble with that one, go back and review the video called If Current Liabilities Increase, You Need to Add to Cash Flows. Let's see. And that's it. So what we're going to do is we're going to sum these. So take 24,000, subtract 4,500, add 5,600, subtract 8,000, subtract 2,000, add 2,400, and you get 17,000. Stupid comma. 500. Then we're going to take 68,500, add 17,500, and we get positive $86,000 cash flow from operating activities, which is the most important section of the statement of cash flows and is a good sign. Nice work. So now we move on to the investing section. So what goes in the investing section? Changes to long-term assets. You can also see it over here. Investing cash flows are changes to long-term assets, such as buying equipment or selling land or buying land. So what we're going to do is we're going to go up here. I'm just going to use this. I guess that doesn't work. That doesn't go on top. Let's see if it'll work now. There we go. So I got this on top so I can block off these things one at a time. So what I'm going to do is I'm going to go through this list here, one by one to see which of these affect long-term assets. And if they do affect long-term assets, we'll see if they affected cash. So common stock, that's equity. So that does not go in the investing section. Depreciation expense, we already did. Here we go. Purchase of equipment. Equipment is a long-term asset, and we purchased it with cash. So we're going to include this in our statement of cash flows. And since we purchased it, we have to, cash is going down, therefore we have to put it as a negative. Let's see here, purchase. Cash payment for acquisition of equipment. Let's keep going down our list. We've got acquisition of land. Here we go. Land is a long-term asset, so that would go in the investing activity section if it involves cash. So does this transaction involve cash? Nope. We just have we got a long-term asset by issuing long-term debt. So that's going to go in the fourth section. So we're going to skip that. Then we're going to go down to book value of the building sold. So notice it says the book value of the building. It's not necessarily saying we got $54,000 of cash. This is just the amount of book value that was removed from our books when we sold that building. So we have to calculate the cash we got. So this is kind of like a logic problem. So let's review really quick from a PowerPoint slide. Calculating the sale, calculating cash from the sale of an asset, in this case, a building. So what's going on here is, here was our T account when we sold this building. The book value, remember book value is cost minus accumulated depreciation. The book value was $40,000, and since it's an asset, its balance is on the left side. So when we sold this building, we had to remove this from our books. So that is why we have credited the building account. We received $50,000 of cash. So this is the amount that we're trying to find for our current problem, the amount of cash that we sold. So how do we calculate the amount of cash that we sold, or that amount of cash we received for selling the building? You take the book value of the asset that was removed from our books, $40,000, and then if it's a gain, the gain will be on this side, so we add the gain. So the book value, $40,000 plus $10,000 gives us the amount of cash that we received. So this is the amount that would go on our statement of cash flows. So let's fill in these amounts with the information we have. So the book value of the building is $54,000. So what we're trying to find out, this number. So the amount of book value that was removed from the from our books was $54,000. So this amount here becomes $54,000. You could just do this on scratch paper, obviously. Ugh. Oh, come on. There we go, 54,000. I see what's going on. And then we need to see if we have a gain or a loss from the homework problem. And it says we have a gain from the sale of the building of $4,500. So this is $4,500. So how much must the cash be if we have credits of $54,000 and $4,500? Well, we just need to add those two up. So we get what, $58,500? So this is the number that is going to go on our statement of cash flows, because that's the amount of cash that we received from selling this building. So $58,500. Wonder if I can copy and paste that. Hey, it worked. So that is cash receipt from sale of the building. So let's see. No, so we're still working on the investing activity section. So I need to go through here to see if we have any other long-term assets. Payment of note payable, that's a liability. Payment of cash dividends, nope. Oh. So we're done with this investing activity section. So we're going to take 74,000. We're going to take 58,500, subtract 74,000, and we get minus 15,500. So what this means is cash went down, so we were spending cash for investing activities. And mostly it was for acquiring equipment. Next is the financing activity section. So what goes in the financing activity section? Changes to long-term liabilities and changes to equity. So let's go back up here. Start with this one. Does this affect a liability or equity? Issuing common stock for cash. So we received cash, because that's what we get when we issue stock. Cash receipt from issuance of common stock. Since we received cash, we'll keep it positive. I'm just going to double click that, copy and paste. What else do we have? Depreciation, acquisition of land. Now this is a long-term liability, but the cash is not involved. So that's going to go in the fourth section. And we got payment of notes payable, $46,100. So since we paid this, that's a negative number, minus $46,100. Cash payment of note payable. See what else we got? Payment of cash dividends. Now, remember, cash dividends are paid out of retained earnings. Retained earnings is an equity account. So this goes in the financing section. And because we paid it, it's a negative number. Cash payment of dividends. Do we have anything else? Yep, we issued notes payable. So that's a long-term liability, so it's going to go in the financing section. And we received cash, so that's going to be positive. Cash receipt from issuance of notes payable. And I know we're out of line, so I'm going to double check just in case I made a mistake. Nothing else? Okay, so now we're going to take 38,000 minus 46,100 minus 50,000 plus 62,000 gives us what? 3,900, 3,900 positive cash flow from financing activities. And the main thing was issuing this note. Well done. We're almost done. Net increase, decrease in cash. There's two ways to figure it out. Here's the old number. Here's the new number. So what's the difference? So subtract 99, or it takes 99,400 minus 25,000, and we get a net increase of cash of 74,400. Then we've got last year's cash balance. So we just double click that, copy and paste. This year's cash balance. And one thing you should do is to double check this number, you're going to sum these numbers. 86,000 minus 15,500 plus 3,900 should give you 74,400. And then the last thing we got is non-cash investing and financing activities. We got that right here. We acquired land by issuing long-term note payable. Acquisition of land by issuing long-term note payable, $119,000. Leave it positive. And that's it. There's no more of those. Now we can check our answer, and that's it.